As the COVID pandemic continues to rage on the world and India grapple with the new realities, central banks have stepped in to provide liquidity and governments are stepping in with fiscal support. The global economy faces an uncertain future and the Indian economy is no exception. Our engines of growth had slowed down considerably pre-COVID, and since the start of the lockdown, arguably the most stringent in the world, the economy has stalled. Prime Minister Modi has promised to unleash reforms to reposition India as a destination for FDI while urging citizens to support local. So today on the inaugural episode of our marquee show, Global Dialogues, we speak with Ruchir Sharma, the head of emerging markets and chief global strategist at Morgan Stanley Investment Management. Ruchir is also the best-selling author of Breakout Nations in Pursuit of the Next Economic Miracle and contributor to the New York Times. We talk about the big global reset, the 3Ds, deglobalization, debt and digitization, and the outlook for emerging markets and India specifically. Ruchir, always a pleasure. Many thanks for joining us on the inaugural episode of the Global Dialogues. I want to start by talking to you about India and the way that we should assess the crisis. Now, a lot of people are drawing parallels to the past, specifically to 2008, to assess the impact on the Indian economy as well as the response. Now, in terms of the response, the claim from the government is that the Indian government's response is almost 1991-like. Before we talk about the response, let's talk about the economic impact.
Right. As far as India is concerned, there's been a very strong decadal pattern which really goes back to the 1980s. That if you look at India, at the start of every decade, it seems as if we are hit by some crisis often triggered by global events. So in 1980, we had the balance of payments crisis, which forced India to go to the IMF. That marked the first opening up of the Indian economy, the first sort of small wave of liberalization. The 1991 crisis is obviously very well documented, which again pushed India back to the wall and India reformed. Then once again, we had the tech bust that took place in 2000, and we got some reforms in 2001, 2002 to try and get India back as far as the growth trajectory was concerned. Then the 2008-2009 crisis wasn't really that, because it was largely seen as an external event and confidence in India itself was very high. But in 2012-13, we had a sort of more India-centric crisis to do with inflation, and that also led to some reforms, particularly the adoption of an inflation targeting regime. So yes, we have had this pattern where at the start of every decade, we seem to face some crisis, and that crisis, as is typical in most emerging markets, forces the government to carry out some reform, and we could well be at that juncture today, because this is about as big as any crisis that India has ever faced, with India's economy expected to contract for the first time since the late 1970s. So this is even bigger than anything that we have seen over the last 4 decades.
This is perhaps the biggest that we've seen and in terms of economic impact for India in the last 4 decades. Ruchir, you're talking about this being the first year of negative growth for India since the 1980s. Now, in response to that, we've seen measures being taken by the Reserve Bank of India, liquidity lifelines being provided, and there is a stimulus package that's been announced by the government of India as well, which we're seeing play out in tranches. Now, what is your own analysis in terms of how effective the measures by the RBI as well as the stimulus measures announced by the government are and can be going forward?
So as far as the stimulus measures around the world are concerned, there's a lot of noise about what the true numbers are. And that's what I've tried to do here in a few charts to try and show you as to how should we really see what's happening worldwide. So there are 4 kinds of stimulus that governments across the world and policymakers across the world are enacting. One is what we call the discretionary fiscal stimulus. This is the amount of extra money that governments are spending or cutting taxes to try and provide relief to citizens around the world. As you can see here, that in the developed world, the stimulus has been much bigger compared to the emerging markets. And within emerging markets, India's stimulus is much smaller so far in terms of what other countries have enacted on the pure fiscal front. That's the one sleeve of the stimulus. The second has to do with the credit and loan guarantees. In this regard, India has done much more so far than what other emerging markets have done. We should not be comparing these numbers to the developed world, because although I'm showing the developed world numbers, all emerging markets have to understand that they cannot carry out the same sort of stimulus that the developed world does just because of the confidence that the developed world and the investors have in that credit. So the second sleeve of the stimulus has to do with credit guarantees. India sort of is up to 3.7% of GDP. That is larger than what other emerging markets so far have done. The third sleeve has to do with the amount of rate cuts. Here again, India is sort of in line with other countries where interest rates have been cut by 75 to 100 basis points, but there's not much scope for rates to come much lower given how low real rates were before we went into this crisis. And the fourth sleeve of the stimulus has to do with the expansion of the central bank's balance sheets, the form of central bank asset purchases, or QE, as is known in many parts of the world. Here again, what India is doing is somewhat short of other emerging markets, ex-China, because the number is kept very low by China. But here, India's central bank expansion in terms of its balance sheet has been quite significant this year. So a sort of mixed picture is what we get. But here is the critical part, and this is where we have to sort of be very realistic about things. India entered this pandemic crisis with the highest, or amongst the highest, fiscal deficits and the highest public debt to GDP ratios in the developing world. So it is very unrealistic to expect that India can do a lot more, because your starting point is very relevant. And when you enter a crisis with such high public debt to GDP ratios, that is something which acts as a natural constraint. And we've seen it around the world, that countries like Brazil, Egypt, these kind of countries with similar public debt to GDP ratios have been similarly constrained to do something. And when they've tried to do something more bold, the currencies have taken a very big hit.
That is the risk that you point out, and which is perhaps limiting the ability of the government to provide a much more direct fiscal stimulus. But on the issue of debt and deficit, Ruchir, and this is a debate that's currently underway here in India as well, on what should be the route ahead as far as deficit financing is concerned. The argument is that, look, it cannot be, or it should not be seen necessarily as catastrophic if there were to be monetization of the deficit. Where do you stand on that, given where we find ourselves in terms of other emerging markets, and if that were to be an option that were exercised?
I think that the risks are very clear if we do that. We have to be prepared then for a very weaker rupee and its attendant consequences. Because you have to see, India's public debt to GDP ratio is likely to hit 80% by the end of this year. Typically, in emerging markets, when public debt to GDP ratio crosses 60%, it leads to higher borrowing costs. And if it crosses 80%, it leads to a very significant increase in borrowing costs. And this is, I think, that's somewhat lost in this debate, which is that we keep looking at the Western examples for wanting much more monetization, much greater sort of spending, but their long-term interest rates have fallen following the crisis. US interest rates, as you well know, the 10-year is at 0.5%. There's $14 trillion of negative yielding debt across the world today, mostly in places such as Europe. In India, long-term interest rates have not fallen following this crisis. They're still above 6%. So to compare what's happening to the in the developed world is just so misleading. And this is what I say is India's impossible trilemma, which is that we want to impose a lockdown which is as stringent as any country in the world, even more stringent than countries in Europe. We want a fiscal stimulus which is larger than the United States even, or somewhere in that magnitude. And we are a per capita income country of $2,500. I think that this is what just doesn't square the circle, particularly when your public debt to GDP ratios are already so high to start with. So this is, I think, a very unrealistic expectation, and I think we have to be more modest about where we are, what is our per capita income, and what can we do at this per capita income.
So what can we do, Ruchir? And I'm glad that you raised the issue of this impossible trilemma that India faces. So what is the prescription then going forward? Before I talk about how the stock markets are reacting to what we're seeing play out on our screens, this impossible trilemma that India faces, what is the way forward then? And in which way should we temper expectations?
Right. So I think that we have to do in terms of to bring alive the animal spirits with much more reforms. that's the only way of attracting capital in this kind of environment and keeping confidence high. So now we have to see as to what the government does on that. You know, like in 1991, we want to keep using that example. That was not about fiscal stimulus and what was done back then. A lot of that was about what kind of reforms have we done, and is India moving away from this grip of statism and socialism? I think that is the fundamental fault line as far as India is concerned. And we've seen some traces of that even in this crisis, where you have much more powers being given to bureaucrats and other people who can tell you, you can open your factory from X time to Y time, you can only do this. Is fear which is there of the district magistrate that has incredible powers. And I think it's that what we have to really tackle, which is that if we really want to be another East Asian model, I think the East Asian model is fundamentally misunderstood in this country. In East Asia, they spent very little on welfare and a lot on infrastructure and supporting business at the early stages of development. And that is something, and here, I don't think we quite understand that we need to sort of let businesses operate more freely and stop treating all businesses as being corrupt or, like as crooks, because that is the mindset which destroys entrepreneurial spirit. And we need to do much more to support that. So I think that it's much more those kind of reforms that we need to focus on and get out of this socialist and statist mindset if we truly want to be even a middle-income country like Korea, Taiwan, China, and all those countries did. They did not sort of let the state dictate terms and interfere in business the way we do here.
Well, that is the hope that perhaps that will be part of the reform agenda that the Prime Minister has promised in his address to the nation. But I'll get to that in a second, Ruchir. I want to talk about the lockdown specifically because arguably, India has had one of the most stringent lockdowns anywhere else in the world. Now, as far as emerging markets are concerned, how are they dealing with the lockdown exit? And what should be the prescription then for India? We're getting close to the 17th of May when we have to decide what lockdown 4 looks like and link it to the economic impact.
Yeah, so there is no better stimulus for the economy now than getting India back to work. The question is that how should it be done? But I think across the world, the debate is very clearly shifting from the great lockdown to the great reopening. Everywhere the sentiment is building that we need to get back to work. As someone on my team put it, that lockdowns are like holding your breath. There's only that long that you can do it for without choking yourself. So we need to sort of get back and suffocating yourself. So we need to get back, have a plan to get back to work. And I think that the very clear sort of thinking is shifting in that direction. And here I just want to make one point, which is that as far as emerging markets are concerned, in pure health terms, so far at least, this pandemic has been much less catastrophic compared to the developed world. The fatality rates in emerging markets, which is like a more accurate way possibly of reading the data because the case counts are sort of distorted by testing. But if you look at the fatality rates of the top 20 countries in the world, there is only one emerging market in that top 20, and that's Iran. And that is possibly due to the cold weather and the demographics, that Iran has a much higher demographics. But there were 19 of the top 20 countries in the world with the highest fatality rates are countries primarily in the northern hemisphere and developed countries. Similarly, in the bottom 20, in terms of the countries with the lowest fatality rates in the world, there's only one developed country, which is Japan. Now, what's the common pattern? We don't know enough about this virus. But so far, based on big data, what can we infer? What we see is that the incidence of this virus in the emerging world today has been about 4 to 5 times lower than what has been the case in the developed countries. And that may largely be, this is again speculation, but just putting the empirical data together, this may largely be due to BCG vaccinations, heat, sunlight, demographics, and potentially lower urbanization. So I think those are factors that may have contributed to lower incidence of the pure virus. So what this tells you is the fact that we cannot, in the developing world, we just can't follow the lockdown policies of the developed world because the nature of this virus and the way it's hitting it is very different. And the second factor is that we don't have a welfare state or a support mechanism like the developed world does, and we have a much larger informal economy. Yes. So keeping those constraints together, I think that it is not right to just be following what the developed world is doing. And I'm happy that even in places like India, the debate is shifting now towards the great reopening rather than just doing what the developed world is doing in terms of its lockdown strategy.
You're absolutely right that the incidence of fatalities, etc., much lower in emerging markets like India versus the developed world. And we do not have the state capacity to provide the kind of welfare that the developed world can provide. So, yes, that has to be thought through as we move towards this reopening. But, Ruchir, I want to now talk about the markets. And I want to talk about emerging markets in the last decade that we've seen and what your prognosis is for the road ahead, specifically with respect to India as well.
Yeah, so as you said, that this has been the worst decade for emerging market equity investing in post-war history, since the Great Depression decade. And this is a far cry from how we began the last decade. In fact, as I wrote in my book in Breakout Nations a decade ago, that at that point in time, my feeling was that the BRICS are all overhyped. And I was in search of other breakout nations, trying to go from Turkey to Indonesia. But I ended that book by saying that the true breakout nation in the world is America, given its technological prowess. I wish I had organized my investing career more around those lines. But having sort of seen that, I think that this is a very telling moment for emerging markets and could be a very important moment as well. So if you look at emerging markets such as India, here's the data which will really sort of surprise people. In inflation-adjusted terms, the Indian stock market today is 25 to 30% lower than where it was in 2007. And that's true of all emerging markets. In dollar terms, the numbers are even worse in terms of where where the Indian market today is compared to its 2007-2008 high. So this has been a terrible decade for investing in emerging markets. And all the people who told you that long-term investing is fine, you just sort of invest in these countries, have just been proven wrong because the last decade has been so bad. Now that's the bad news. The good news is this, that these markets are so depressed today that a basic analysis of mine shows that if over the next 5 years, these markets return back to their long-term trend, we could see an annualized gain in dollar terms or inflation-adjusted terms of 20% a year over the next 5 years. So I think it's very important in the game of investing to know what's your starting point. A decade ago, the starting point was against emerging markets. Today, the starting point is in favor of emerging markets, including countries such as India. And assuming this long-term trend is not broken, we could look at annualized returns over the next 5 years if there's a mean reversion out there of 20% or so for emerging markets such as India, which is the kind of return that I'd be more than happy to take.
Well, yeah, I think a lot of people will be more than happy to take that kind of return, especially given what we've seen happen over the past decade. But Ruchir, where is the leadership going to come from specifically for the Indian market? What is going to lead the recovery and the return to trend?
So I think that that's a very important point, because globally, if you look at the leadership, over the last decade, particularly over the last 5 years, the entire leadership has come from tech. So, this is a fascinating sort of data here, which is that over the last 5 years, the entire appreciation in markets around the world and the increase in earnings has mainly come from 6 stocks worldwide. And they're all tech-related stocks. And those 6 stocks being Amazon, Apple, Google, Microsoft, Netflix, Facebook. These 6 stocks have totally captured the world. Their market cap today is $6 trillion, which is more than around 4 times the market cap of the entire Indian market. So these stocks were virtually nowhere a decade ago, and they have risen. So tech has clearly been the game to be. And the problem in India partly has been that we don't have such tech giants here. Very few countries do, in fact. Only China, you can argue, has similar sort of tech giants. But in the absence of these tech giants who have been eating everybody's lunch practically, it's been very difficult to make money anywhere in the world. And the leadership has been distorted, like in India it's been financials. Now in India, of course, companies like Reliance and all are trying to position themselves to be part of this cohort. So that is what I think is sort of, like obviously starting to intrigue a lot of global investors. And there could be other companies like Bharti and all which sort of follow in a similar lead. So that is potentially one kind of leadership. But the way I'm thinking about building a portfolio for the next 5 years is what I call a barbell portfolio. On one hand, you want to play these themes, which is that these secular growth themes, and this pandemic has only accelerated the trend of greater digitization, greater sort of e-commerce. So you want to play those themes. On the other hand, I want to own some very beaten down stuff with a lot of quality names that have been beaten down. So in sectors such as energy, in sectors such as consumer staples, consumer discretionary, there are enough stocks across emerging markets, including in India, that have been very badly beaten down, but where the franchise value is still strong, that you want to own them. So a barbell portfolio consisting of these two cohorts is the way I'm thinking of positioning for the next 3 to 5 years.
Okay, that barbell portfolio that you spoke of. There seems to be, Ruchir, this epic battle that's underway between fundamentals and liquidity. And it seems very clear, at least if you look at the US markets, that the equity markets are not linked to fundamentals in any form or fashion, largely because of the kind of stimulus that's been thrown at the markets. Now, how do you see the markets sort of coping with this in the near term?
Yeah, so asset prices are just being propped up a lot because of the incredible amount of liquidity. By some measure, the total amount of stimulus that's been put to work by the G7 nations in this episode is already 5 times larger than what they put in 2008, 2009. And what the central banks and the other authorities cannot do is control where this money goes. So unfortunately, that a lot of the stimulus is still finding its way into asset prices. So you have an artificial propping up of asset prices because of liquidity. It's hard to see how that ends, because that is just the reality. When you have interest rates that are that low, you will have people sort of follow what is widely now known as a term that used to be used in Indian psephology, the Tina factor. There is no alternative, so they end up buying equities and other risk assets. But within that also, it's all being channeled into the existing winners. The leaders keep leading. All the money is going primarily into those 6, 7 stocks in the developed world that I spoke about. And in the emerging markets, it's 5 stocks which are capturing a lot of that imagination. Tencent Alibaba in China, Samsung TSMC in Korea, Taiwan, and Naspers. These 5 stocks, again, tech-related, have been going. So I think that that is the pattern at some point in time we want to see break. And when the economic recovery begins, wherever it does, I think that a lot of the small cap companies that have been beaten down are the ones where we could see greater appreciation over the next 5 years or so. Every single recovery in the US in the last 50 to 70 years, small caps are the ones which have led on the way out. So I think that that's where I see the liquidity shifting. But in general, asset prices seem like that they're going to remain higher than justified by fundamentals because of this incredible amount of liquidity and this epic battle that's going on between fundamentals, which are still deteriorating, with global growth forecasts still being downgraded, earnings still being downgraded, but being offset by this swoosh of liquidity that the central banks and other policymakers are putting out there.
You know, since you talked about how narrow the market currently is, Ruchir, but you also believe that small caps will lead the recovery phase. Any themes there as far as the small caps are concerned that we should be watching out for?
Well, it's a bit early for that. As I said, that the next few months are likely to be difficult, but in general, a concerted move across the cap curve is where we should see. But as I said, it's the same barbell portfolio kind of stuff, that the more domestic-oriented sectors, I think, across the world, including in India, are likely to do better. Because one of the big themes that we will speak about is deglobalization. And in that environment, I find that like owning companies with too much of an external exposure is not going to be a very winning strategy over the next 3 to 5 years. So of course, again, in the short term, with a weaker rupee, you may find some of the exporters doing okay, particularly the IT services. But over the next 3 to 5 years, I think a more domestic-facing market given the focus also on domestic growth, I think is going to be the way. And typically small to mid caps tend to be oriented much more towards that cohort across the world, including in India.
Before we talk about deglobalization, digitization, and other big macro themes, Ruchir, let me end by asking you in this segment on what the key risks could be to the India economic story as well as the India equity story.
Yeah, so as far as India's economic story goes, I think that the main risk at present is the fact that if we are forced to extend this lockdown much further, if there's a second wave or third wave, the capacity for countries like India to handle that is extremely limited. And I think that if that we need to carry on with this sort of reform momentum that we are talking about, but we still have to see the details of, because that's the only way out of this sort of crisis. But I think that if we lose our nerve and just say, we're going to print our way out of this, I think that that could lead to even greater problems down the road. And then, because once those expectations come unhinged, then it's very hard to stop something from cascading into a more sinister kind of crisis.
Well, that is a concern, and thanks very much for pointing that out. Of course, that's a decision that hasn't been taken as of now. We are going to take a break and continue our conversation here on the Global Dialogue with Ruchir. But stay on with us. We're back to the markets in a minute, back with a lot more.